Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeezes. Today, we're peeling back the layers on a microcap ticker that's caught our attention due to an absolutely eye-watering cost-to-borrow fee, TGHL. Ever wondered what happens when it becomes incredibly expensive for short sellers to bet against a company? We're going to explore exactly that with TGHL. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show TGHL logo/ticker on screen. Let's get right into TGHL. This is a microcap company, and while its specific sector isn't readily available for public classification, its market dynamics are what truly stand out. We track a variety of metrics for squeeze potential, and TGHL appeared on our hard-to-borrow screener for a very specific reason. Its annualized cost-to-borrow fee currently sits at a staggering 773.1%. That's not a typo, over 700%. With an estimated float of just 12.7 million shares, this relatively small pool of tradable shares can amplify the impact of any significant borrowing demand. Now, it's critical to note the current trading picture for TGHL. Looking at recent price action, the stock has shown a 0.0% change today, 0.0% over the last 5 days, and 0.0% over the last 30 days. Similarly, recent volume data shows today's volume at 0 shares and the 30-day average volume also at 0 shares, resulting in a relative volume of 0x average. This means that, despite the high cost to borrow, there has been virtually no recent trading activity. This is a truly unique scenario we'll unpack. What is cost to borrow and why it matters? So, what exactly is this cost to borrow fee, and why should you care, especially when we're talking about TGHL's 773.1%? When a short seller wants to bet against a stock, they first have to borrow shares from an existing owner, often through a broker. They then immediately sell these borrowed shares, hoping to buy them back later at a low price and return them to the lender, profiting from the difference. But borrowing isn't free. Short sellers pay a fee, known as the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. Think of it like renting a car. The longer you rent it, the more you pay. With stocks, if a stock is in high demand for shorting but there are very few shares available to lend, the rental fee, the CTB, skyrockets. And yes, it can absolutely exceed 100% annually because it reflects an acute supply-demand imbalance in the borrower market. For short sellers, a CTB like TGHL's 773.1% is a constant, hefty drain on their potential profits, creating immense pressure on their short positions day in and day out. Why this stock is hard to borrow right now? For TGHL, that 773.1% CTB tells us one thing very clearly: this stock is extremely hard to borrow right now. While we don't have data on the specific number of shares currently available to borrow, the sky-high fee is a strong indicator that the supply is incredibly tight, and demand from short sellers is significant, even if not accompanied by active trading volume. The fact that CTB momentum isn't available for TGHL means we can't track if this fee is climbing even higher or stabilizing, but its current level alone is a major signal. When a stock is hard to borrow, it means that brokerage firms have very few, if any, shares left in their inventory that they are willing to lend out to short sellers. This scarcity is what drives the borrowing cost through the roof for tickers like TGHL. Now, the perplexing element here is the zero trading volume. This suggests that while borrowing demand exists to create this high CTB, there's no active market trading to either push the price up or provide liquidity for short sellers to cover. It's a paradox that highlights potential, but also a current lack of market action. Squeeze mechanics explained. So, what happens if a stock like TGHL, with its high CTB and small estimated float of 12.7 million shares, were to experience a short squeeze? A short squeeze happens when the price of a heavily shorted stock rapidly increases, forcing short sellers to cover their positions. To cover, they must buy back the shares they initially sold, which ironically drives the price even higher. Imagine short sellers betting against TGHL. They're paying 773.1% annually to hold those short positions. If suddenly some positive news emerges, or just enough organic buying pressure enters the market, and the stock price begins to tick up, the short sellers start losing money. The higher the price goes, the more they lose, and eventually, many are forced to buy back shares to limit their losses or meet margin calls. This cascade of forced buying creates a positive feedback loop. Buying drives the price up, which forces more short sellers to buy, pushing the price even higher. Our internal composite squeeze score for TGHL sits at 46.5, a moderate score that reflects the significant CTB pressure but likely takes into account the current lack of market momentum and volume. A squeeze is a fight for shares, and with a small float like TGHL's, if demand were to pick up, the limited supply could make that fight very intense. Dilution risk check. One critical factor to consider when evaluating any potential short squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. While sometimes necessary for fundraising, dilution can significantly impact a short squeeze thesis. More shares mean the pie is cut into more pieces, reducing the value per share. Crucially, new share offerings can also provide liquidity for short sellers, giving them an easier way to cover their positions without driving the price up significantly, effectively negating the squeeze potential even if the cost to borrow is sky high. For TGHL, our check found good news on this front. We found no recent dilutive SEC filings such as -1s, -3s, or 424B filings in the last 90 days. We also found no recent reverse split for TGHL in our look-back window. This means that, at least based on recent filings, the company isn't actively increasing the share count, which would be a positive sign if a squeeze were to begin. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, with TGHL's 773.1% cost to borrow, zero recent trading activity, and a moderate squeeze score of 46.5, what should you be watching for? First, it's vital to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay a premium to maintain their short positions. For TGHL specifically, the absolute top thing to watch for is a significant increase in trading volume. Currently, with zero volume, there is no market activity for a squeeze to even begin to form. Without buyers and sellers actively transacting, even the highest CTB won't move the needle. Secondly, monitor for any company-specific news or catalysts that could generate genuine buying interest. A squeeze needs a spark, and news can often provide that. Keep an eye on any future updates regarding the cost to borrow, though momentum data is currently unavailable. This is a stock currently sitting dormant in terms of trading, but with the underlying pressure of an extremely high borrow fee. TGHL presents a fascinating, albeit unusual, case study in the world of hard-to-borrow stocks. With an astounding 773.1% cost to borrow and a relatively small estimated float of 12.7 million shares, the fundamental pressure on short sellers is undeniable. However, the current lack of any trading volume or price movement means that this potential remains just that potential, for now. As professional educators, our goal is to show you how these mechanics work in real-world scenarios. TGHL perfectly illustrates the disconnect that can sometimes exist between borrow market dynamics and active trading. If you found this deep dive into TGHL informative, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments if you have any questions or other tickers you'd like us to explore. Thanks for watching, and we'll see you in the next video.